If you are age 65 and older and trying to figure out how to withdraw from your retirement accounts, the fear of creating an irreversible IRS tax trap is a real and understandable concern. Crossing a threshold by just one single dollar could cost you thousands of extra in Medicare premiums or just unnecessary taxes. By the end of this video, you will understand the 2026 tax rules, including the new bonus senior deduction, as well as how to create a strategy where you could actually pay $0 in federal income tax by the way that you structure your withdrawals. Most people enter retirement thinking that naturally their taxes are just going to plummet because they're no longer earning that standard regular paycheck. But the reality is, the IRS looks very carefully at all of your retirement portfolio withdrawals. And if you're not careful, you could end up severely overpaying. Now make sure you stick to the end of the video because I will be walking you through a withdrawal sequencing strategy that you can use to withdraw from both pre-tax and Roth accounts and have a nearly 0% federal tax rate. Before we begin, my name is Andrew Matz. I'm a financial planner at Oak Road Wealth Management, and we specialize in helping pre-retirees and retirees with $1 to $2 million retire confidently. So now let's dive straight into the foundation, which is how much of your income is protected from taxes right out of the gate. For 2026, the baseline standard deduction has been increased for inflation. And this standard deduction is the amount that your income is reduced by automatically. So you don't have to pay taxes on this amount. For a single filer, this amount is $16,100. And if you're married filing jointly, this number is $32,200. This is for people who are under 65. So if you're 65 and older, things get even better, but also more complicated. So first, there's the regular deduction boost. So if you're married and both you and your spouse are age 65 and older, you automatically get an extra $3,300 added to your baseline deduction. But here's what most seniors are totally missing. Under the One Big Beautiful Bill Act, there's a new temporary senior deduction of up to $6,000 for single filers or $12,000 for joint filers, assuming that both of them are 65 or older. Let's look at all of these deductions together for a married couple in 2026. So the base standard deduction is $32,200. Then we add on the regular deduction boost, which is $3,300 because both again are over 65. And then lastly, under the One Big Beautiful Bill Act, there's the new senior bonus deduction that they both qualify for, so in total $12,000. That means a married couple can shield up to $47,500 of retirement income before paying a single penny in federal income tax. However, unfortunately, there is a bit of a catch. So for this new senior deduction of $6,000 or $12,000, it's actually restricted by your income. So if you cross $75,000 or $150,000 for single or married filing joints, the IRS begins to decrease the amount of the deduction that you receive, and eventually it will get totally 100% phased out. So while you're in this range, one move that you make can end up basically being taxed twice because you're taxed on the actual income plus you're getting a decrease in the amount of the deduction that you receive. Now that you know how big this tax-free shield can be, the million-dollar question is, what account should I withdraw from to actually fill it? And this brings us to traditional versus Roth withdrawals. The old conventional wisdom was very simple. It said that you should first withdraw from your taxable accounts, like cash and just regular brokerage accounts. Then you should draw down your pre-tax retirement accounts, and then at the very end, draw down your Roth accounts. And to some extent, there is some truth to this. But following that advice today may actually cost you more in taxes. If you let your pre-tax account continue to grow until your mid-70s, eventually you'll reach your RMD age, or required minimum distributions. And this is where the IRS actually forces you to take money out of your traditional IRA. This counts as income, and it can push you into higher tax brackets, increase your Medicare premiums, and phase you out of those senior deductions that we previously talked about. Instead, a more modern approach would use tax bracket management. And this would involve pulling first from your traditional IRA up until a certain threshold, such as the 12 or 22% tax bracket, and then supplementing the rest of your lifestyle with either tax-free Roth withdrawals or with brokerage account withdrawals using long-term capital gains rates. By pulling from multiple buckets simultaneously, you have more control over your taxes and you're able to better steer away from major tax traps. But as you start balancing these retirement buckets, there's a hidden expense that you really have to keep an eye out for, and it doesn't follow the regular progressive tax brackets at all. It's all or nothing, and it's called IRMAA, or the Income-Related Monthly Adjustment Amount. This isn't technically an income tax on your 1040. Rather, it's a surcharge that's directly applied to your Medicare Part B and Part D premiums, and it's based off your income. But make no mistake, it acts just like an aggressive tax on your portfolio. The standard Medicare Part B premium is $202.90 each month, and this is what most retirees pay. However, if you cross certain income thresholds, your premiums can skyrocket. Let's look at the official 2026 IRMAA tables. So if you're a single filer and your income is $109,000 or less, or $218,000 or less for married filing jointly, then you just pay the Medicare regular base of $202.90 per month. However, if you cross those income thresholds by just one single dollar, then your Medicare Part B premium jumps to $284.10 per month, plus you have a Part D surcharge as well, which is an extra $14.50. And it's per person, meaning that it's an extra $1,148 per year per person. For a married couple, that's an extra almost $2,300 in annual premiums. And as your income goes up, those numbers keep going up as well. IRMAA is a strict cliff. $1 over the thresholds, and you pay the entire extra premium. There's no prorating. But here is the most dangerous part of IRMAA, and it's why so many retirees get blindsided. And it's called the 2-year look-back rule. The government calculates your Medicare surcharges based off your income from 2 years prior. So those income tables we looked at were for your income on 2024. And that means the decisions you're making right now will affect what your Medicare premiums will be in 2028. And that brings us to the biggest trigger of these look-back penalties, which is Roth conversions. Don't get me wrong, I'm a big fan of Roth conversions, and they can save a lot of money on taxes over your lifetime. Moving money from a traditional IRA to a Roth IRA, so moving into that tax-free wrapper, and then simultaneously filling up those lower tax brackets, is a really great strategy that everyone should consider in their financial plan. The real issue here is not having a plan and converting too much in one single year. So if you were to convert your entire traditional IRA to a Roth IRA in 1 year and you have $1 million traditional IRA, your income is going to skyrocket, and along with that, your Medicare premiums in 2 years are going to skyrocket, and you're also probably going to phase yourself out of some of those senior deductions. So now, how do we take all that we learned and create a blueprint for a 0% federal tax bracket? Now, quick disclaimer here. Although paying no taxes is great, over your lifetime, doing Roth conversions to fill up lower tax brackets and actually paying taxes this year may save you taxes in the long run. So it's definitely worth something to consider. Let's take a look at a quick case study. So we have a married couple. They're both age 66 and they need $80,000 a year from their portfolio to sustain their lifestyle. That's where they're comfortable at. It's also worth to keep in mind in here for this case study, this couple, they have no other sources of income. They're delaying their Social Security, so they have no Social Security income, and also they have no brokerage account in this scenario. They just have a traditional IRA and they have a Roth IRA. Traditional advice would tell them to just pull all $80,000 out of the traditional IRA, so their adjusted gross income will be 80 grand, and they'll end up owing tax, probably thousands of dollars in federal tax. But look what happens if we apply the tax bracket management strategy that we discussed earlier. Now this time, the couple will pull $47,500 from their traditional IRA, and the rest of it, the $32,500, now this will come as a Roth IRA distribution. Now let's look at their tax return math. Now their adjusted gross income will only be the $47,500 because Roth withdrawals do not count as income at all. So they only have $47,500 in income, which keeps them well below any phase out for both IRMAA or for the senior extra deduction as well. And when you apply their standard deduction plus those extra bonus senior deductions that we learned about, their tax-free shield is going to be $47,500, which was the exact amount of income that they have. So their taxable income is a net $0. $0 in taxable income, meaning of course that there's $0 in taxes as well. You know, granted, I am talking just about federal taxes here, but $0 in federal taxes. Tax planning is so important to your retirement plan. And if you need help creating this plan, please click the link in our description below to schedule an introductory call with us to see if we may be a good fit for each other. But otherwise, thanks for watching, and please subscribe and like this video below.